You just launched 3 product features that failed. You think, statistically, the next one has to work. This isn't logic. It's a massive mental glitch called the gambler's fallacy, and it's bankrupting good business ideas. The gambler's fallacy, also known as the fallacy of maturity of chances, is the mistaken belief that a deviation in an observed sequence of independent random events is likely to be corrected in the short term. In simple terms, it's the belief that because something hasn't happened recently, it's due to happen, or conversely, because something has happened frequently, it's less likely to happen again. It's the core reason someone at the roulette table bets big on black after seeing red come up 5 times in a row, thinking, "The universe owes black a turn." This belief is fundamentally flawed because it ignores the principle of independence. In the world of true randomness, past events have absolutely no bearing on future events. Every coin flip, every dice roll, and every spin of the wheel is a fresh start with the same probability. Applying this flawed logic to data-driven business decisions is a recipe for disaster, transforming sound strategy into a costly emotional gamble. The false expectation that luck owes you a win is the subtle killer of innovation and a betrayer of basic data literacy. Let's break down how this fallacy cripples good business decisions and data analysis. The primary victim is the marketing budget. Imagine a company runs 5 consecutive online ad campaigns, all of which underperform their target conversion rate. An executive, caught in the gambler's fallacy, might argue, "We've spent too much money and time for this to keep failing. The next campaign must be a winner. Double the budget for the next one." They view the string of losses as an aberration that is due for a correction. The rational, data-driven conclusion, however, is that their underlying hypothesis, targeting or creative strategy, is flawed, and that merely increasing the spend on a bad strategy will only accelerate the failure. The previous campaigns were independent tests. Their failure points to a structural problem, not an impending lucky break. The cost here is not just the wasted extra budget, but the lost opportunity to pivot to a different, more effective strategy. Another critical area is product development and A/B testing. A team might run 10 A/B tests on their website, all of which show statistically insignificant or negative results. A product manager under the influence of the gambler's fallacy might insist on rolling out the next test with a massive portion of the engineering team's resources, arguing, "We've had 10 losses. We are statistically due for a huge winning design that will justify all the time spent." The data reality is that all 10 tests, whether they won or lost, were independent trials. Their collective failure suggests a need to re-examine the fundamental user problem they are trying to solve, or perhaps the quality of the traffic they are directing to the site. The correct data interpretation should lead to a strategy review, not simply an escalated bet on the next random idea. The false expectation trap turns iteration into self-punishment. This also leads to dangerous forms of data manipulation. When results consistently disappoint, teams may start to p-hack or engage in selective reporting, desperately trying to find a segment or metric where the luck finally turned, all to satisfy the internal narrative that a win was due. This ruins the integrity of the data and guarantees the team learns the wrong lesson from the experiment. In the realm of hiring and team building, the fallacy manifests in destructive ways. A manager might interview 10 candidates for a critical role, none of whom are a good fit. They might tell the HR department, "I can't believe we've seen 10 duds. The 11th person we interview has to be fantastic." This leads to rushing the hiring process for the 11th person, lowering standards and overlooking red flags, all because the manager's brain has decided they are due a quality candidate. But each candidate pool and each interview is an independent event. The low success rate points to a flawed candidate sourcing strategy, a poorly written job description, or unrealistic expectations, not a statistical guarantee of imminent success. The cost. A bad hire, which is one of the most expensive and damaging mistakes a business can make. The team loses morale, productivity drops, and the initial problem is exacerbated. All because the manager trusted a mental fantasy over a data signal. The psychological root of the gambler's fallacy is our innate human desire to find patterns and causality in randomness. Our brains are hardwired to predict the future based on past information. When we see 5 reds in a row, our brain, searching for an explanation, incorrectly weaves a narrative of cause and effect, where the cause is the past sequence and the effect is the necessary correction. We struggle to accept that some events are truly memoryless. The coin has no memory of its last flip. The server has no memory of its last crash. The campaign has no memory of its last failure. The key to data literacy in business is cultivating the mental discipline to recognize when a sequence of events is truly independent and when it is causally linked. When an event is independent, the only probability that matters is the original baseline probability. When an event is causally linked, like a series of failures resulting from a bad piece of software, then the probability of future failure is increased, not decreased, by the string of past losses. This distinction is paramount. Is this a random failure independent, or a systemic failure causally linked? Mistaking a systemic failure for a random one leads to wasted effort, while mistaking a random event for a systemic one leads to unnecessary overhauls to escape the gambler's fallacy. Leaders and teams must adopt a mindset of radical independence and clear hypothesis testing. First, formalize every experiment. Never simply try something. Every marketing campaign, every product feature, every sales pitch should be treated as a clear, isolated test of a defined hypothesis. After the result, explicitly state the conclusion. This test proved hypothesis X was false. This makes the failure a valuable piece of data, rather than a cosmic signal that you are due a win. Second, calculate and commit to baseline probabilities. If your average email open rate is 30%, after 10 consecutive emails that open at 20%, the gambler's fallacy says the next one will open at 40%. The data-literate decision says your email subject lines or list quality have deteriorated, and the new baseline is 20%, unless you change the underlying variables. Third, seek out and incorporate true causality. Instead of assuming the next failure is less likely, ask what, if anything, links these failures. If the answer is the same flawed internal process, then the probability of future failure is actually higher. Invest in fixing the process, not in gambling on luck. This forces you to shift from being a passive recipient of random chance to an active manager of controlled variables. By focusing intensely on the inputs, the quality of the hypothesis, the rigor of the test, and the integrity of the data, we take control back from the false idol of luck. This methodical approach ensures that even a losing streak is productive because it systematically eliminates flawed assumptions. Finally, adopt a Bayesian perspective. Instead of viewing each result in isolation, let each new piece of data update your overall belief in the core strategy. A string of losses doesn't mean you're due. It should significantly reduce your confidence in your original plan, leading to a disciplined pivot or termination, rather than an impulsive, double-down bet. Ultimately, the cost of the gambler's fallacy in a business context is the erosion of rational decision-making and the betrayal of data integrity. By relying on the false expectation that luck will correct itself, you ignore the clear objective data telling you that your strategy is broken. You are effectively making a moral bet that the universe will reward your persistence, rather than a logical bet that your strategy is sound. True data literacy is the humble acceptance that random events are random, and that success in business is built on rigorous hypothesis testing, continuous learning from failures, and the discipline to walk away from a statistically hopeless path. no matter how long the losing streak has been. Luck doesn't owe you a win. Success is simply the result of playing the probabilities correctly, one independent event at a time.